Good evening, Canada. Welcome to week 5 of the Investor's Guide to Thriving for fall 2021. Tonight, as always, we're going to feature Mr. Larry Berman, host of Berman's Call on BNN and our Chief Investment Officer and my longtime business partner at ETF Capital Management. On the program this evening, we'll be talking green. And I don't just mean this unstoppable bear market, or that Larry will give us an update on central bank money printing. And both Larry and Danielle from BMO ETFs will be talking about green investing in clean energy and in support of reducing climate change. But before we get going, I'd like to take a moment to tell you a bit about our group of companies, which began back in 2006 when Larry and I launched ETF Capital Management. And there we do two main things. Firstly, we partnered with BMO ETFs to manage the Sleep at Night ETF and funds of ETFs, which are available to you through your financial advisor or online brokerage. We also provide holistic family wealth planning and pension fund-like investment management directly to those with portfolios of 1 million plus. You can learn more at etfcm.com, where we just launched a beautiful new site. If you're looking for pure fee-based financial planning services, U-Potential is our solution for that need. And Golden Girl Finance is our digital media site specializing in financial content by women for women. And lastly, Q Wealth Partners by Quintessence Wealth is our advisor platform, providing a cutting-edge alternative to traditional independent brokerages. ETF Capital Management is in fact the original partner, but we've since been joined by 10 other advisory practices from coast to coast. And these days it seems like we're adding one more per month as word spreads about our innovative wealth tech capabilities. Well, it's about time to get the show going, but before we do, Larry and I would like to thank those of you who have joined us in support of the research efforts at the Sick Kids Foundation to find better cures for childhood leukemia, and the Baycrest Foundation, where we support their world-leading Alzheimer's and dementia research efforts. If you'd like us to match your donations, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links there. This is how we're able to track and match your generosity. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. Tell us how we did and you'll get a link to access all of the above and submit questions for next week's webinar. Well, now as promised, let's give a warm welcome to Danielle from BMO ETFs.
Great, thanks so much for that, Jared. So great to be here tonight. I love being part of this webinar session, so thank you so much for having me. So you mentioned it, the topic tonight, I'll be touching on it, and then Larry's going to be touching on it, is clean energy. I think we cannot ignore this, especially this week with everything that's going on with the COP26 conference. And you know, I guess over the last year and a half, COVID has been dominating the headlines, but really not far behind this in terms of headlines has been climate change. And much like COVID, climate change is a global disaster. It is affecting everyone. And we're really seeing this manifest as we're seeing these worsening forest fires, floods, severe weather patterns, hurricanes and storms hitting urban areas. These are global issues caused by climate change, and they're costing us all across the globe money, and they're costing us lives. So because of this, there's been this hugely increasing amount of awareness and attention towards climate change, and we are seeing greater efforts on all levels, countries, businesses, and individual levels to change behaviors and actions to do our part in reducing the impacts of climate change. And you know, you can't talk about climate change without talking about clean energy, and that's that transition from fossil fuels and coal to renewable energy resources. And from the investment side, we are hearing more and more from investors on this theme. So we really wanted to provide some education tonight around the clean energy megatrend and give investors some insight on how to approach this trend from an investment lens. So if we think about, you know, what is driving the change or what is actually being done to move the needle on climate change, well, the COP26 Climate Summit, this is a great example where the leaders from many nations across the globe are getting together and they're making meaningful commitments to net zero emission targets with the goals to keep the average global temperature from rising 1.5 degrees Celsius. And in order to hit these targets, there must be significant capital investment into clean energy infrastructure and clean energy technologies. But it's not just governments collaborating in Glasgow at the COP summit. Of course, this is where all the media attention has been focused, but there are financial institutions and corporations there as well, discussing how they too will commit to keeping these targets and keeping these global temperatures from rising above that 1.5 degree mark. And a couple examples of what corporations are intending on doing to help impact this or move the needle. So Microsoft, they have a goal to remove all the carbon that the company has emitted in the environment dating back to 1975 when it was incorporated. Amazon plans to be carbon neutral by 2040. So we have both governments and large multinational corporations making these commitments, and it's really going to take massive capital investment to get us to these goals. And the beneficiaries of that investment really are going to be the leading clean energy producers and companies who create these green energy technologies. So I'm also going to highlight about the COP conference that BMO, we have individuals from our responsible investment team in Glasgow right now at this conference. They're actively engaging with corporations to encourage them to make responsible decisions when it comes to environmental initiatives and goals. So we actually have boots on the ground involved in this conference, and that's something we're really proud about. So what else is going to help move the needle? Well, the US is back in the game. So we've seen Biden has been probably the most photographed face at this conference. This is good news for anyone who wants to see this green energy revolution move forward. Of course, Biden rejoining that Paris Climate Agreement and then committing, the last I checked, the figure was $1.75 trillion to put towards clean energy and infrastructure. So more than $1 trillion is committed to be investment. So think about that. That is a huge figure, and that's just the US. So if we start thinking outside of the US, high emitting economies like China, Japan, South Korea, the UK, even the EU are all making their own net zero commitments. And these are also going to take trillions of dollars, significant investment to move forward. So if we just move to the next slide, so we know there's going to be some big spending from governments and some big spending from corporations to hit these zero emission targets. But is this an affordable or sustainable way to power the future? So I picked up the most recent IRENA report. So IRENA being the International Renewable Energy Agency. This report's great, a lot of great information. It's publicly available if you want to do a deep dive on their website. You can read it tonight if you want. But what I discovered was the cost of clean energy is actually declining. And this is across the board. And this is very important to highlight because when we think about clean energy as a growing trend or as a powerful mega trend, well, it really will not take off if the cost is way more expensive than traditional energy sources. So if, tonight, if there's any economists in the room, they'd be the first to tell you that the element of cost curve decline is just so important for a trend or a technology to truly explode and to grow exponentially. So here what you're seeing is the cost decline of energy sources dating back to 2010. So this is the black chart on the top left. And what we're looking at here is the dollar value per megawatt hour. And in 2010, onshore wind and solar, these were quite expensive relative to traditional sources. But fast forward, so now over the decade, these costs have significantly decreased, making them much more competitive with those traditional energy sources such as coal and natural gas. And then the second graphic here shows the year-over-year decline in the price of each clean energy. So this is from 2019 to 2020. And what we can see here, again, that trend is deepening. So these energy sources are all getting cheaper, which means they will become more widely used and they'll be more accessible to all regions on the globe. So if we just move on to the next slide, so another graphic, this one coming from a BP report. So BP being a traditional oil and gas company who is well aware of the headwinds it is facing. And what they are forecasting is that by 2050, more than 40% of energy used will come from renewable energy sources. So that's the orange line on this graph. This forecast is assuming this rapid transition. So this assumption, it basically assumes that the governments and corporations will hit their emission targets that they've set out for themselves. So if these emission targets are hit, then this is what renewable energy growth will look like looking out. And under this assumption, renewable energy will actually become the most widely used form of energy by around 2035. That's not that far away. So again, forecasts from even traditional energy companies are showing this tremendous growth in clean energy. Okay, so I've outlined a couple tailwinds here for the clean energy sector. You know, that significant investment from governments and corporations into clean energy producers and the technologies, and then that cost curve decline to access these energy sources, just another tailwind for that global growth and adoption. But let's bring this all back to investing now, because this is why we're here tonight, right? So just moving on to the next slide, I have another great chart to show you. Investors are well aware of these growth opportunities within the clean energy space. To make this clear, just take a look at the chart on the slide here. So what we're looking at is asset flows, so dollars that went into clean energy ETFs in the US over the last 16 years. And well, this just speaks for itself. So there was relatively no interest in clean energy. And then we hit 2020 and over $7 billion, almost $8 billion in 1 year went into clean energy ETFs. Investors were looking to get that exposure to this long-term secular growth trend. And then of course, looking to an ETF, which is a really efficient way to get this exposure, because with an ETF, you can access an entire portfolio of clean energy stocks covering all the clean energy subsectors and sub-industries, and then really maximizing that exposure to clean energy without having to do the stock picking, so minimizing that stock specific risk. So clean energy ETFs, as you can see, wildly popular in the US. Now, I'm showing you the US flows because in Canada, well, we didn't have many clean energy ETFs until early this year. And then several clean energy ETFs actually came to market in 2020 here in Canada. I'm proud to say I got to work on a team that helped at BMO that helped list Zed Clean. So we listed Zed Clean in January. This is the BMO Clean Energy Index ETF. It tracks the S&P Global Clean Energy Index. You may have heard of this index because it's the index that iClean tracks down in the US, which is a fairly popular clean energy ETF. So we are just thrilled to have brought this exposure to Canadian investors. So this ETF provides a global basket. We think global is very important to really identify all the companies that will be exposed to clean energy. So this global basket of the leaders in clean energy, the producers and the technologies. There's about 100 companies or 100 stocks in the portfolio. And again, just a really great way to maximize that exposure to the clean energy megatrend while limiting that stock specific risk. So if we just move to the next slide, because clean energy is a growing trend, or I call it a mega trend, it's just so powerful. This is a growth area of the market. So Zed Clean I describe it as a growth ETF because it's really positioned to capture the growing clean energy trend as it plays out over the next 3, 5, 10, and 15 years. So if we just look at this data here, so the Clean Energy Index has actually outperformed the traditional global energy index, but you can see they've tracked relatively close for a while, and then 2020 was clean energy's breakout year when a lot of investors started realizing the growth opportunities and the investment that will be directed to these companies. And then 2021, you see kind of these companies take a bit of a breather. But I will say that these valuations have pulled back. So if clean energy is something you believe in, and this is a growth trend that you really see playing out, we're actually seeing quite attractive valuations and attractive entry points right now in this space. So before I close it out, I just wanted to show you what Zed Clean looks like under the hood. So this is something I always talk to investors about. When you're looking at an ETF or thinking about investing in an ETF, go see what that ETF is holding. Go see what the sector makeup is, the regional makeup is. All of this is available to you online. Not every clean energy ETF is the same. They are all different. They could be tracking different indexes, or they could be actively managed. So do your research. Zed Clean, of course, tracks an index, has about 100 companies globally, and then holding many clean energy producers, exposure to solar power, wind power, renewables, but also a significant portion is to the IT bucket, the information technology sector. And these are the producers of the technologies that enable these energy sources. So an example here would be a semiconductor company. Semiconductors are very important pieces of equipment when building out these renewable technologies. And so you'll see some semiconductor companies in this portfolio as well. But all of these companies are going to be the direct beneficiaries from the spending that will continue to build towards that green revolution evolving. So the ticker there is Zed Clean. Management fee we think is very competitive at 35 basis points. And then one more point on this topic before I pass it off. So at BMO, we don't just list a clean energy ETF or list an ESG product and then drive on and not pay attention to responsible investing. No, actually, responsible investing and ESG integration is truly part of our investment process across the board. As I mentioned earlier, we're really proud to have boots on the ground in Glasgow right now, actively engaging with companies. But what we also do that many investors might not know, we proxy vote. We proxy vote on all the shares that we manage, all the companies we're monitoring. We have a dedicated responsible investment team who makes these votes, informed votes for us. And we have actually the best voting record among ETF issuers in Canada. I'm proud to say that as well. I'd like to show you the Market Insights webinar. Thank you so much for our time tonight. If you're interested in participating in more free educational content, just like tonight's show, come join us every Friday at 1 p.m. where we get together. We put on a great 30-minute show. We talk about investing in ETFs. We talk about the market, etfmarketinsights.com to register. And now the man that needs no introduction, Larry Berman, I'm going to pass it off to you.
Thank you so much, Danielle, for that introduction to clean energy. And with COP this week, I just have some feedback for you there too. I had some renovations done to the house over the last year and a half. Should have taken 6 months and took a year and a half. And I talked to the electrician about maybe doing a combination of batteries and wind and solar. And I really embracing on a personal family basis the idea of being green and managing the heat in the house and airflow and everything else. And he said it would cost to fully do my house probably around $200,000 a year to get off the grid. And I that was probably way more money a few years ago, but it is coming, and it is coming quickly. So that was an interesting graph to share. A decade ago, I wasn't bullish on the space from an investment standpoint because of cost. When you study businesses and cycles, what you see is that the markets, and you'll see in some of the charts today, the markets price in so much of the next decade or more that it becomes a bit of a challenge in terms of finding value. And so one of the things Danielle commented and said there was good value there now, and I'm not so sure. So we'll have a look. But it is an exciting sector. It's something that I'm personally, advocating. I think the move to a green world is a very, very good thing. It's a shame that it hasn't really taken hold before, but it does need technology. It does need technology to get to a point so that you can break through barriers, and that's a pretty important part of it. So I'm going to give you a quick update on my thoughts on what happened with the Fed yesterday and the central bank printing press around the world and what that means. Some of the questions are coming in already on that. And then we'll dig into climate change and what I like to call the transitionary element, uranium, being pretty key. I talked about it on this week's show. I've talked about it more than a year ago when I first started putting investments in the funds around uranium. It was a tragedy, obviously, a decade ago. We just passed the 10-year anniversary of Fukushima, and there's been some others, of course, tragic. You get the world saying, yeah, nuclear makes sense, but not in my backyard. So let's have a look at that, and then we'll get into some Q&A. One of my good friends out of Chicago posted on LinkedIn this picture of Jerome Powell, apparently his prep school yearbook comment. And so I'm sure it wasn't real, but I wonder what he was thinking about inflation in 1972, if that was transitory or not. In any case, the world is leveraged to easy money policies. And this graphic that I'm showing you here looks at the earnings yield of the S&P 500. So, based on the earnings per share, if you invert that number, it turns into a yield of the market. And so if you look at the blue line in the middle and the earnings yield of the S&P, you can see recently and at the trough of COVID last year, we got to the point where the markets, from a yield earnings perspective, was as expensive as it was at the peak of the tech bubble. What I want to orient your eyes to here is the red line at the bottom, which is the long bond yield. And back at the peak in 1990, long bonds were at 6%. And so, it's a very different world than we're at today, where long bonds are 2%. So there's this concept in markets called the equity risk premium. And because equities are more volatile than the cost of money, debt, that you have to factor that in. So the equity risk premium today is about as low as it's ever been, or pretty close to. And so for the multiple of the stock market is a lot higher, but it's higher because of the factor, not that earnings are better. In fact, the earnings rate today is in line with the extreme in 1999, 2000, and we should be very concerned about that. But because money is so cheap, there is no alternative, as you've heard. So we are very levered to easy money. QE is going to be an absolute part of the Fed toolbox going forward. They're going to try to raise interest rates probably in the back half of next year, maybe into 2024. And at some point, we'll get a shock like we saw in 2018 when they started to raise rates. and then they'll have to cut them again back to zero and do more QE. That is the world we live in, folks. The permanence of easy money because of the massive debt in the world. And the sad reality around COVID was the tens of trillions of dollars that could have been spent on fast tracking climate change was spent on trying to end this pandemic. And as a tragedy is to mankind, climate change is an equal tragedy to mankind if what some of these projections are. Now, I don't want to get into a debate with people. Is it real? Is it not? Is it fake? I'm of the camp that it's real. I'm not sure it wouldn't have happened anyways, because there are cycles. We've had ice ages before where there was no carbon emissions. I kind of jokingly say a bunch of dinosaurs were farting and their methane emissions perhaps caused, climate change back then, who knows? But it's definitely something that the world is serious about. It's pretty clear. But I also think from a policy perspective, governments have handcuffs on. Biden wants to spend all this money. He hasn't been able to. It's a problem. This is going to cost tens of trillions of dollars to fix, and who's going to pay? And ultimately, I think it's going to be debt that's monetized by central banks as part of the factor. So it's an issue. This graphic that I pulled off a climate report that I've been reading a lot of these lately, basically shows that whatever we've done in the past decade hasn't worked. It's great that the technology and the cost of these newer technologies are such, but the world's made a big mistake here. And the mistake is trying to go cold turkey on the old way we create energy, not having enough of it, and therefore you get price inflation around energy, which kind of we're seeing now, because when you look at a BP and a Chevron and Exxon, they're not investing as much in replenishing their reserves because they know whether it's 10 years, 20 years, or 50 years, what they produce today is not going to matter very much to the world. The coal companies, the toxic emissions coming out of coal is amongst the worst, as we know, but the ramp up and the demand for coal is off the charts, and these coal stocks are been ripping higher because of that underinvestment. So you're going to have much more volatility in the traditional carbon-based energy space, going forward. This is going to be a big part of it. Now, that promotes investment opportunities. I was out recently at a social event. It was actually a Raptors game with some of the ETF folks at Bank of Montreal, and we had this conversation, and they were talking about doing a option-based strategy. BMO is very good at the covered call type strategies in energy. And I said, you know what, I would love to see a combination of old energy and new energy. And so today, maybe that ETF is 70 or 80% old energy, covered call, yield generation, and 20% new energy. And over the next 5, 10, 20 years, that the mix changes as we move from old energy to new energy. Wouldn't that be a great way for people to migrate from an investment perspective? Anyways, have no idea if that's going to become fruition, but I thought it was a great idea, and it's really kind of speaks to the nature of this whole talk tonight. And what's we're going to do a separate ESG focus. E being the environmental impact of ESG type investing. Social and governance, we did it last year. We're going to do a refresher on it in a couple of weeks. We're going to have a specialist from BMO and ESG come on to spend the full hour with me talking about all the aspects of ESG type investing, and we'll go in, how do you affect change how do you become a good citizen? You've got companies from BlackRock on down that have signed on to this principle for responsible investing doctrine in terms of factoring in ESG into your investment decisions. And so we think it's a very, very important part of the future, really. And if you look at ESG and the origins of this type of factor, as we look at investment factors, growth, momentum, value, size of companies, volatility. There's all these different factors, quality of the company's earnings and balance sheet and so forth. And we've talked about these before. The investment factor, ESG, is going to become a bigger and bigger part. And I think investors need to understand and know what it means, need to understand the cost involved and so forth. So we'll do a special one on this, but tonight we're just, because COP is on this week, we're just going to focus on the environmental side, and very specifically because the environmental piece has to do with clean water and all kinds of other relevances for humanity and pollution, but we'll just focus on the carbon impact tonight. So looking at the last 15 or 20 years, there's no meaningful difference that if you factored for ESG, meaning the companies that have been better at being good corporate citizens and trying to reduce their carbon footprint, and have more women in the C-suite and all the considerations around ESG type investing, no meaningful difference in your returns between a broad market index. But if you look at the last 2 years, you're just starting to see a little bit of difference when you factor that extra criteria and say get rid of the bottom half of companies who are not good corporate citizens yet, or maybe have no intention of being. So take the cream of the crop, and slowly, I think this creates a slightly better return for investors, and it's starting to matter. Hasn't mattered for 15 or 20 years, but in the last 2 years or so, it's really, and it's not just no carbon. When you look through one of these ETFs, and in the case what we're doing here is we're looking at the ESGG ETF, which is the BMO MSCI Global ESG Leaders Index. It's not just no carbon. It's not just get out of oil and gas and it's good. These are the companies overall that focus, are just better corporate citizens. And you can see when we look at the names in the energy component of this, that you just see companies that are friendlier and cleaner. So they might be more gassy than oily, certainly no coal companies, pipelines as opposed to guys drilling for oil and so forth. So you can make an impact. I think we have to think about this as transitioning. I get very upset when I hear government policy where it's like, no, you got to stop it now. It's too late. Like, that's just a bad narrative. Is something that takes time. Again, should we have started 20 or 30 years ago doing this? Absolutely, but you can't go back. So if you go too fast now, you break things and you lose jobs. And so it's a process. And so when you look at the companies and the indexes, Danielle mentioned the S&P index that Zed Clean tracks. There's MSCI indexes that, the whole overall. So there's a lot of different types of indexes. There's one in the US that I really, really like that's supported by a very famous hedge fund manager named Paul Tudor Jones. He actually owns part of the company. And the ticker for this ETF is JUST, J-U-S-T. And it's about, you think about justice, but they rank the Russell 1000, so the top 1,000 companies in the US, and they rank them by industry group and overall friendliness. And it turns out, as Danielle had commented on, that Microsoft, in its quest to be carbon neutral, and not only that, go back to 1975 and reverse all the carbon out from their processes and what they used, is ranked #1 in the world. And so when you look at an ESG type index, Microsoft's going to be a big weight on it. If you look at some of the other ones, semiconductors, Apple, so a big weighting in technology, generally speaking. But if you look on the right side here, within the energy component, Chevron, so here's a great example. Chevron pumps your gas, they drill for oil, they have service, they're integrated, big company. What is Chevron going to be in 50 years from now if the world meets their goal to be carbon neutral, right? It's not going to be a company anymore. So if they want to be the energy company of the future, these traditional energy players are investing big in new technology, whether it's algae that creates the oil that we burn or some kind of other factor that they're investing in to become the energy companies of the future. So I would encourage you to use the JUST rankings, have a look through them, get familiar with the companies that are the industry leaders. And those are the ones that if this is something you want to have in your portfolios, that you use this resource as a guide. And it's something that for my company we're launching, not with Bank of Montreal, but for clients of ETF Capital Management and Q Wealth, we're launching an ESG fund that will be a combination of ETFs and single stocks, where when we find value in the individual names, like a Microsoft perhaps, not today, I think it's an expensive company, same with NVIDIA, but when they get into a value range, that's when I would sell out a bit of the ETF and bring in that individual company where I think I can get a lot of growth from, because I like the investment value. Right now, it's a challenge. There's not much that falls into the growth at a reasonable price category, and I'll talk a little bit about that. We had a client come to us recently and said, Larry, I want you to build me a portfolio, no oil and gas. And I said, John, changing his name to protect the innocent, said, John, it's not about no oil and gas. I get that you want to go fast here, but I think you got to think about transition. There are a couple ETFs out there, been out for a decade now in a couple cases, smog and carbon, CRBN. There's a few others. And what I'm doing here is I'm comparing the different ways to play low carbon as compared to traditional carbon. And it's plain and clear and obvious where the trends are. And the divergence really started a couple of years ago, where for a long time, clean energy and old energy kind of went up and down together. One gets expensive, money starts to funnel into the other, and so forth. And so they were very tightly correlated. And now they're starting to become uncorrelated. And so if you are interested in a low carbon ETF solution, I would have a look at smog and carbon as something that you may want to include in your portfolio. And you might say, Larry, why don't I buy smog? It's got a better track record. You got, as Danielle said, you got to look under the hood. You got to see what's in it. You got to see what you're investing in. And so when you look at smog, you can see its outperformance is because it has a big weight in auto manufacturers. 15% of this ETF is Tesla. Okay, so you got to look at it. Tesla is outrageously valued in my mind right now, and it may get worse. I commented when it got put in the S&P 500 at about half the price it's at now, that was crazy ridiculous, and absolutely I look like a moron because now it's doubled in price. It doesn't change the fact that it's not priced right. Now, if I had Kathy Wood on here, and we're hoping to get Kathy to do something for us in a future webinar. She is very, very good at looking at the future and thinking about long-term value and where things are worth 5 or 10 years from now. And I have no great expertise in that area. I'm a tactician, right? I'm about the next couple of quarters, maybe the next year or so. And I don't do that kind of deep dive work. She thinks Tesla is worth, I think $3,000 is her price target 5 or 10 years from now or something like that. And every day it seems like it's more and more reasonable. But the speculation on the options markets, to me, this is a car company. But anyways, I'll digress there. You got to look in the ETF and see what's under the hood. So I want to talk a little bit about the transition period, because this is something on Berman's call I highlighted probably going back about a year, where we first started really nibbling here, because for a long time, uranium was not in my backyard. They're shutting down, they're decommissioning, and we don't want it. And now Japan has realized 10 years after Fukushima that they've got to turn all those reactors back on. They just can't create enough energy without burning coal. And Japan has no natural resources. They got a little bit of offshore natural gas. They import everything. So when your economy is weak from the perspective of creating energy, you are at the mercy. So Germany shut down the reactors. So they go buy their energy from France, which produces 75% from nuclear reactors. So the space is kind of, yep, let's get that. It's pretty clean. It's large scale. We can produce a lot of energy. Not in my backyard, thank you, because of that radiation and nuclear risk. And the reality of the world is the amount of people that have died from radiation and nuclear fallout is this big compared to all kinds of other tragedies that happen. And so while you don't want it in your backyard, that part is very complicated. That as the technologies have improved, these things are more and more feasible. There's the number of reactors that have to come online in places like India and China. Listen, if China and India don't play ball, and China didn't show up to COP26, which I don't get them sometimes, but they like to make statements that way. And they're ramping up stockpiles of coal, just tells you where they're at, and how the demand and the growth from urbanization. So you have 2.5 billion people, give or take, so more than a third of the world's population, that half of those people don't even have air conditioning, right? So the future, or cars, the future demand for energy output, and whether that's electricity for a battery powered car or electricity for an air conditioner, the demand for electricity is going to go up and up and up, and nuclear has to be part of the solution. So, when you look at this space, you got to look at it from a long-term perspective. Where are we today? And right now, it's not cheap. We've had a really good run up, and I've actually been trimming my exposure to Cameco tactically. But we dipped from the first move up above 30, and I was selling in above 30, and we dipped back to almost 25 within weeks, and I added it back because I believe it. So it's a thematic play for transition from old to new, and I think it's going to be a core part maybe for the next decade or so. Now, eventually, less nuclear, but it's going to be a big part of the next decade and beyond, probably. So quite positive on that. But when you step back and you kind of look at Cameco and you say, well, let's go pre-Fukushima, and you can see 2010, 2011, the ramp up in nuclear. We need it. Fukushima hits. And then you had a decade of underinvestment, and nobody wants it, and uranium's useless, and it's a dying industry. And all of a sudden, we've got a renewed sense of greening the world, and the world's getting behind it. Nuclear's got to be part of that. So question is, we're going to get a lot of resistance around the 35 to 40 range from that peak a decade ago. So somewhat cautious here, but it's a buy dips and buy pullbacks, and that's kind of how I think about it, and being tactical. When we look at the profitability of Cameco, there is at Red Lake, Cigar Lake mine. They had a big disaster a decade ago. It's really impaired them. The biggest producer in the world is Cameco and Kazakhstan, and there's a couple big companies, but Cameco is the world leader here. We have it here in Canada, but if you look at the profitability of the company going back a number of years and where it is today, the stock is expensive. For 2022, it's expected to earn 19 cents a share, and it's trading at 30 odd bucks. So that makes it pretty darn expensive from a fundamental perspective. And the question is, well, when they were firing on all cylinders, pardon the pun there, what was the multiple, and what did this thing trade at? And so there's some upside, but we do need to see China and India and more reactors and that uptake for this thing to break out, I think, beyond what we've already seen already. So just bear that in mind. Sprott recently launched a fiscal, they have the UU unit, and they launched another vehicle recently to buy spot uranium. And Sprott is one of the smart guys in the mining space, and this is the uranium price one that's linked to fiscal uranium. U-U is the ticker there, and again, you can see the current relationship of price back to the Fukushima high, and you can see we're kind of getting there, but there is more potential here. So I think it's a pretty important part of portfolios in the transition, and I'm using it. Again, it's a couple percent of the portfolio exposure. You don't make it 20 or 30% of your portfolio. That's a big bet. That what if hydrogen all of a sudden is blue hydrogen? What if that's the future? And all of a sudden nuclear, boom, gone. New technology comes in, it gets wiped out. So you never want to make a massive bet. So 5% would kind of be the most I would think about and putting into that sector. Okay, so clean energy. So Danielle highlighted the BMO Z Clean. Prior to BMO launching theirs, I had been advocating and recommending the iClean. So Z Clean for Canadian taxpayers is kind of a better way to play it. But Danielle said there's some value there, and I look at this, and one of the challenges with this space is that there's not a big yield there. So the dividend yield on the underlying holdings on a weighted basis, 1.44%. And the price to book is a little over almost 3.3, and the current PE is over 60. So you're pricing in a lot of earnings growth that will come to this sector in the years to come, but you're paying for that today, and that makes it challenging. And what that typically means is there'll be more volatility in the sector. So again, it's kind of how do you invest in it and how you trade it, and buying dips is kind of the way to think about it. Danielle covered in her presentation some of the holdings, but I want to look through the ETF. She said, make sure you know what you're buying. And so I'm going to look at the top 3 holdings. Interestingly enough, solar, wind, and battery and hydrogen are the 3 kind of plays there. So Plug Power, Vestas Wind, and Enphase, which is the solar play. So when we look at, how do you trade these things and how do you invest at them? This is what I do. So I always compare it to my benchmark and what I'm trying to beat or achieve. And in the case of this sector, buy low, sell high. That's my narrative. That's my mantra. That's my yin and yang and my namaste. I like to buy low. So Enphase right now is on the high side of the relative range versus ICLN. In September, October, it was at the low side of the range. In July and August, the high side. And so this is something that you would add and trim. And right now, I'd look to be trimming some exposure against the highs from December and January, as it's relatively overbought compared to its benchmark, i.e., when I create these ESG core, so my core is the broad index. So let's call that iClean in this space. And then do we want to emphasize one stock over the other by selling some of that ETF and buying that individual security? Right now, this is not one I buy for a couple reasons. The fundamental price target of the analyst, that blue line that you see running across the chart there, currently, the green histogram tells us that it's trading above its 12-month price target. But back in September and early October, it was trading at approximately a $50 price discount to that 12-month target. So to me, that was attractive relative to iClean and so forth. So that would be the ideal time to step into a name like this. And so the question is, would you buy it today? The answer is, I'd have a little bit, but I would be underweight, whatever that means for you. Okay, that's the important thing about this. So again, when we look at the earnings and the fundamentals, here's a company now that's profitable. Danielle talked about costs coming down and everything else, and that's very true, but market share is growing for these guys. So, 2022, 1.9 billion in revenue, and they're expected to earn about $3 a share on stock trading at $240. So you quickly do the math and you see this thing's trading at about 80 times earnings for next year. And so that's not cheap, it's kind of expensive. And this is where, how do you put a fair multiple on a growth industry like this? And you can't. And so when bad news hits, these stocks can have a lot of downside volatility, okay? Because if there's a miss, that becomes an issue for the name. Okay, so let's look at wind. So Vestas Wind is the biggest in the world. And so this is a pretty important play. And if you looked at its relative right now, earnings just came out. I guess they disappointed. I haven't gone through the report yet. But they were trading at looks like a $30 premium to their forward price target before earnings. And those earnings, I guess, weren't stellar. They didn't beat or they didn't upgrade enough of the outlook. And all of a sudden, the stock gets crushed, right? So that's the space. Just understand it. But now it's starting to trade at a discount to the price target. And while the chart doesn't look good, it's been range bound for the better part of a year. We're now at the lower end of that range, and relative to iClean, there's a little bit of value there. Okay, so that's, from a chart perspective. But when we look at the fundamentals here and what the analysts think, you can see the recent upgrades, which came yesterday and today, and the analysts not upgrading, but updating their targets and their ratings. You can see that the consensus rating is a 3. That's not a great reading on Bloomberg. The red arrow down tells you there's been more downgrades than upgrades recently, and there's 12 holds versus 7 buys and 7 sells. So this is, again, a sector, when you look at what it's trading at and what it's likely to earn, again, they're making money. Revenue is 16.9 billion next year, 16 billion this year, but they're going to make 76 cents on that. And so where's the multiple? These things are expensive. So again, Danielle commented there's some value here. I'm looking at the big weights in the index. I don't see the value. The whole index is trading at 60 times earnings. Now, if you think that's the right multiple, then by all means, make a big bet. But I think it's a little expensive. So we have exposure in the portfolios because I like the theme, and we're kind of trading it around. We're adding and subtracting as it kind of fluctuates and goes up and down. And again, sectors like this, I tend to want to think about them that way because it's too hard to get a real big position in something that's very, very expensive. Now, if you don't look at that and you don't care about it, fine. There's other ways to trade it, and you have to take a momentum perspective, not a value perspective that I kind of take. And you trail up your stops, and there's nothing wrong with that. You could do that too. It's just not my style, so I don't teach it or recommend it because it's not my style. So, okay, so let's look at battery and plug power. They're creating batteries. There's some element of hydrogen here, and so very, very interesting play. But when you look at analyst targets, it's pretty much there. When you look at what happened in December and January, and you see it rip like that, this is the craziness of how analyst recommendations work. So this stock is breaking out in December. It's trading above analyst recommendations. Again, the blue line, you can see it up there. It rips higher in early January. Reddit speculation, this was one of the names. Kathy Wood was buying it, one of her names. This stock's ripping. And so analysts are upgrading their targets because the Pied Piper, and they're following the herd. That's what they do. And now the stock's underperforming and it's dropping, and they're dropping their price targets. So the analyst price targets, these guys don't know what these companies are worth. And that's a point here to really drive home. They are moved by the market, and so trading and investing in these areas, guys, is not as simple as buy and hold and forget about it. And while I love it as a theme for decades to come, you're going to have a lot of volatility in these names. And while we love the space, so would I buy Plug Power right here? I was writing puts on it in my option portfolio in April and May when it started to come down. Again, value-wise, lower end of the range to iClean. That's what I look for. So it was trading in the low 20s, mid 20s. I was writing puts at 15. I was generating a 1% income every month while I was waiting to buy it at 15, and I would have been happy buying it at that point compared to 60, all right, or 50, or 30, or 40 for that matter. Now it's up at 40. I have no interest in it at all. I'm not talking about the next 5 or 10 years. I'm talking about trading perspective. So when it comes back to trend, and when there's more upside potential relative to analyst targets, to me, that gives me a comfort level on the when decision to invest in this thing. If you're a momentum guy and you're looking purely at this chart, you look at it and you say breakout, base pattern, go. And that's fine. You can do that, right? But you better make sure you trail your stop up, because eventually it's going to do what it did in January and February again, and maybe run up more than this, could run up to those old highs before it breaks again. Nobody knows, right? That's the challenge here. So again, fundamentally, let's have a peek. These guys, their revenue, 800 million next year, 500 this. So there's a lot of growth there. So that's great. Their power purchasing agreements, 27% 3-year growth rate, all good there. They don't make any money. They're not going to make any money next year, and probably the year after that, from what I'm reading in some of the reports. So, you got to take a view that you're investing in a company that's not going to return you any money. There's going to be no dividends. And if they don't execute really well, they could be Ballard Power. Do you remember Ballard Power 20 years ago, by the way? It went dormant for a decade, in terms of its investment prowess. And it became one of those things that you have in your portfolio that's trading at a couple pennies that used to be trading at a few bucks. And that could be a Plug Power. I'm not saying it will be at all, but I'm just saying you got to think about the risks. And when you look at analysts, what their recent things, they all seem to like it more than Vestas, in terms of buys versus hold versus sells. So take it for what it's worth. That's kind of my dive on some of the ways that I'm looking at these sectors in terms of playing them, and hope that gave you some insight here. So let's dig into some questions here that have come in, and then I'll take the online ones. So tapering officially started and markets go up. Do you put cash into an S&P Innovator buffer here? So again, yes would be the answer based on what my pro eyes indicators are telling me right now. You want to have a bit of a hedge on. What I've done in my portfolios is I've bought the put spread, the downside protection, but I haven't sold the upside off yet. Why? Because seasonals this time of year are very strong, and I don't want to give up. We could get into a stupid melt up here. Not because I'm bullish, not because of fundamentals, not because of anything, but people chasing. And we know how markets work on emotional quotient. And we're in one of those periods right now where the Fed is yes, they're tapering, but they're doing everything they can to tell you how it's not hiking rates and it's not going to be meaningful. And, we're going slow and we can change our speed and everything that kind of Powell leaned into yesterday in the Q&A. So if you wanted to be there in the S&P 500, yeah, I would say that would be a smarter way to do it right now. Do I still think there's value in the uranium sector? So I covered that. So great question. And so yes, there's value there. I think there's a 10+ year trade here. Again, like the whole space, there's going to be a lot of volatility. So great for traders, great for option premiums, covered call type strategies. I sell off some exposure. I write a put to buy it back. I earn the premium. So those strategies I like here. So yeah, I think there's value there, but right here, right now, I'm trimming a little bit. If we experience higher inflation for a longer period of time because of supply issues in the commodity space, and it's beyond commodities, it's labor issues too. Well, at the same time, we have weak economic growth, stagflation, but not like the 70s. What would the view be on the base metals area? So to the extent that the world is slow and sluggish, theoretically, the base metal sector would be weaker. To the extent that governments are able to spend on infrastructure and rebuilding, the base metal sectors, steel inputs, zinc, nickel, lead, those copper in particular and silver on the precious side are big inputs into greenification and electrification in the future versus carbon-based strategies. So, I think base metals are a good way to play, but again, it's going to be volatile and choppy. And so just be mindful of that. Jump in for sure after major corrections, but mindful. ZMT is what I use to play those base metals. Often there seems to be a great disconnect between what's happening in the economy and in the stock market. That's a great understatement, I would say. It seems as during COVID, for example, most stock markets have ignored a weak economic news and continue to rally because of low interest rates and stimulus. Yeah. And now that they're ignoring the prospect of higher rates, well, I don't think they're ignoring it yet, but rates haven't really turned up in a meaningful way. And if we look at the shape of the yield curve between the funding markets under 2 years and the lending markets tend to be 5 to 10 year range, there's plenty of steepness, so profitability in credit. But it's when that curve inverts that there's no profitability in lending and we get that economic and credit contraction. So we're far away from that. And there's not really a disconnect from that perspective. But the equity risk premium that I talked about up front tonight, that will contract multiple points. So if we see the US 30-year that's at 2% now go to 2.5%, the calculation is somewhere between 1 and 2 multiple points of a reduction in the equity risk premium. So that means if we're trading at 22 times earnings, that it would bring it back to 20. Okay. So next year, 220, 225. And right now we're trading at 4,600 on the S&P. Quick math, 21 times earnings. That would take us back to 20 or 19. So each multiple point, if 220 is the earnings, is 220 S&P points. So 2 multiple contraction points, 440 S&P points based on a 4,600 S&P, 9%-ish type correction if the 30-year goes to 250. If the 30-year goes to 3%, now you're talking about 3 multiple points, right? 600. If the yield curve inverts and we get a credit contraction, meaning as earnings start to fall, now you're not 220, you might be 160 or 170 with a smaller multiple. And that's when you get these 20, 30% type corrections. And we're not there yet, folks. That's a 23 or 24 type scenario. The yield curve hasn't inverted. It takes 12 to 18 months to 2 years before we see the economic reality after the yield curve inverts. We talked about this in 2018 and 2019, that there was a pending recession coming. Didn't know about COVID, right? You don't know what the catalyst is going to be to trigger it, but you saw the credit conditions that was projecting it. And so that became a much bigger risk to the equity markets. So thanks for those questions. Let me have a look at some of the online ones now. What do you think about URA and NLR as a way to play the miners? Yeah, I use URA in my ETF funds. Cameco is my name of choice when I'm going to a single stock Cadillac. I like to invest in the Cadillac in each industry. So Cameco to me is the Cadillac of the uranium story. You can speculate in some small cap miners. I don't play that game. I stick with the big liquid companies that are well covered and I can get a lot of information on, and I don't play the juniors in that space. But URA is the ETF that I use, and I like that. But again, my bias at the moment is trimming. That could be different a week from now if the sector pulls back 15 or 20%, right? So it's fluid. I like it as a theme, but I'm trimming a little bit at the moment. So that answers a couple questions. Can I update us? Dave is asking on gold. So I'm pulling my hair out on this one because everything is set up for gold to flourish, and it's not, and it's been the most frustrating trade. You know, I started talking about it 2 or 3 years ago. I was very bullish. We had a phenomenal run. Gold went from 1,100 up to 2,000 and the miners and everything. So that was great. But the last year plus has been absolutely awful. We've had some rallies, no new highs, failed rallies, new lows. The gold miners are the cheapest relative to gold that they've ever been in history. So as a value trade, you have to like it, but you know, what's going to be the catalyst? So I think it needs to be part of portfolios. I think you have to trade them. I've reduced my positions by 60% over the last year, and in particular, in a big way on the last rally we had above 1900, because while I think it should be higher, it's not working. and I got to see it start to work before I start buying dips and get more aggressive. Right now, I'm in a mode to trim because I had big positions in last year, and they were too big, and they stopped working. So that's kind of how I look at that in terms of an update on gold. Let's see here. Let me look at some questions here. So nice to talk about clean energy, but if a high percentage of energy needs to come from solar power, for example, 20 to 50% of the ground will need to be covered up. How realistic is this? Well, Tamar, I'm not sure I agree with that analysis. This is why I think nuclear is important, because it's the big, large scale. But in the places like Nevada and in Canada, listen, solar's never going to work here in a meaningful way. And wind to a lesser extent. The Chinook winds. There's plenty of wind power there, and that makes sense. But really, solar, we don't have enough of it, on a cost-benefit basis. But southern U.S. makes tremendous sense, and so yeah, that's going to be part of it. I think hydrogen and blue hydrogen, basically, so hydrogen to create the frac that's needed to create hydrogen costs a lot of energy. And so you need a renewable source to create the hydrogen, which byproduct is water, as we know, as it combusts. So hydrogen is going to be part of the future, and stabilization, small scale nuclear reactors. Listen, technology is going to solve all these issues in due course. And this is why you hear governments and targets of 2050 and 2060. And can we get to all battery powered cars by 2030 or 2035 and reduce a lot of that? Sure. Do I think an airplane is ever going to be able to fly on anything but oil? That one, I don't know, transatlantic. They're doing island hoppers now, apparently Vancouver Island and the mainland, with battery powered, water skippers there. So, short haul, maybe. So again, technology, I think, is going to solve a lot of these issues. And I think investable themes, and you just got to be mindful of what you pay today. So Tamara, that's a great question. And so thanks for that one. Let's see what else we got here. Thank you for the uncommon and common sense. I really appreciate it. Because no one ever shares the thought. Well, thank you, Deborah, for that. I appreciate that comment. And I really hope you can see the passion and sincerity in why we do these and how we do these. And the investment world is a challenge. I mean, if you just wanted to have a very passive way to do it, great. You can buy a passive balanced portfolio, and you're probably just going to be fine. Very low cost ETF, and you'll probably be fine. And now BMO has these ESG ones, so you can be a good investor and good corporate citizen and vote with your dollars that way to incentivize companies. And you're seeing more and more that I think governments are going to be inept in terms of driving this. They can through policies. I do believe that the US will have a major scale carbon tax. But my comment on getting people to stop, getting your soccer mom to stop driving her car and take public transit, just never going to happen. You can't raise the cost of carbon enough to stop a soccer mom from taking her kids to soccer who lives in an urban setting. So, you know, there's elements of carbon tax that make sense because the basic economic model is to tax stuff you want less of. Sin taxes are like an example of this, where you tax considerably cigarette smoke because it's bad for you. You tax alcohol because, well, it's good for you, it's bad for you in excess, and so forth. So you put taxes on things you want less of, and if you want less carbon use, you put tax on it. But in order to get the soccer mom to stop driving her SUV, that needs to be so prohibitive that you stop economic progress. And that's kind of my belief on carbon, and the real purist there that says we need to do this now. To me, that's nonsense. You have to have balance. You have to think transition. You kind of got to be smart about how you do these things. Someone's asking a question about can I speak to the tax implications of my growth fund in a taxable account? So the vast majority of the focus in the growth fund is tactical and active, which means we buy and sell a lot, which means the primary treatment is capital gain. So from that perspective, it's tax efficient because it's your lowest tax rate, as opposed to a dividend from a foreign corporation, which is treated as income. So we don't focus on yield in the growth fund. And when I put on a hedge, it's done with options as an overlay, which again gets a capital tax treatment. So that's a good thing. But it's not like a passive ETF where there's nothing trading. And if you buy and hold it, there's very little tax distribution at the end of the year. So if you buy a passive S&P 500 ETF or any other index link one, there's some changes to the index. So there is some buying and selling. There's some M&A activity of buyouts and rebalancings that happens, but it's small. So they're considered tax efficient because they don't have big distributions if you don't sell them in the period. Now, if you're an active investor in a taxable account and you're in and out and you're in and out and you're trying to time the market, that's your capital gains tax treatment. So the fund is more like that. It's active. We're in and out. We rotate. I've talked about some of the styling there, but the most of the distribution that would come on an annual basis, Devin, is going to be of capital gains treatment. So hopefully that answers your question there. Okay, what else do we have here? So Michael's asking about ZPay, and yes, so the Chris Heeks, who's the portfolio manager responsible for a lot of the option strategies in BMO ETFs and ZPay in particular, is going to be a guest on the show, on this webcast. I believe it's 3 weeks. We're going between the 21st episode and the 28th episode of the series of when that person's going to be on, and we're going to be covering all aspects of put writing for yield, covered call writing for yield, how BMO structures their covered calls where they only write on half the position. So if it keeps going, there's capital gains potential, etc. I think BMO does a great job in their options strategies, and why I'm not only an advocate for what they do, but a big user of those products. So that's coming. And pretty excited about that. There was a question earlier on about someone wanting to make a charitable donation, and I put out, email me directly, and I can help you with that if you're concerned about the matching portion. But in the email that goes out following this, that has the replay on it, you get some time in the next 24 hours, there's a link in there that says make your donation here, either to sick kids or to dementia and Alzheimer's research at the Baycrest Hospital. And if you click one of those, it goes to websites where we track them and we match those donations on an annual basis for my company and me personally. So if you're looking to make those donations, that's what you would do. So really appreciate that. And a real special shout out, I'm not going to mention a name, but this week, one of the BNN viewers donated $1,000 to dementia and Alzheimer's research. And I am so grateful and thankful to that donation and really glad that I can match that. So thank you so much to all the people who have made donations. Let's see, we're doing this. We got 8 minutes left. I don't see any more questions here. Oh, here's one that just came in. Question about information. Thanks, Larry. You reference a lot of reports and news in your talks. What are some of the major sources of information? Are there any good resources that you could recommend for economic and market information in general? Would you suggest IMF and World Bank research in particular? You know, Lucas, some of the best research comes off the Federal Reserve System. Federal Reserve, IMF would be another example of this. They have thousands of PhDs doing all kinds of research on all kinds of topics, and it's all free. And so depending on what your level of interest is, the New York Fed has a list that they send out a couple of times a week, research reports on what's happening with GDP now and tracking and real-time indicators. And so there's a lot of good public resources. I spend half my day consuming all kinds of financial information, and I get questions, Larry, how can you know so much? I said, that's my job. You know, you have your day job. This is my day job to be the best that I can be at and having an investment opinion. At the end of the day, you know, it requires a lot of work. And so someone commented that the Sick Kids Hospital link did not work. So I thank you for that. I will have a look at that one. So thank you. Make sure that that's working properly. Can I speak about IVOL and INFL as potential ETFs? So last week, Frank, with Rosie on, we commented on those strategies, and I believe I commented on about a month ago when I had Larry McDonald on. So IVOL is done with swap contracts, and it basically has a yield curve steepener and holds some inflation index long bonds. And so it gives you exposure to rising inflation risks and yield curve steepening. And the inflation ETF is slightly different exposure than that. And so these are very acute, kind of like a scalpel surgeon. These are not strategies you can just buy and hold and not think about, because, you know, there's going to be inflation, go buy that. It doesn't work that way, because inflation and these things get priced in and then they get priced out, and the Fed says something and it changes the perception of the market, and you've already paid for that and so forth. I don't recommend using them for the average investor unless you really want to take the time to understand what makes them tick. And like Danielle said at the outset, look at what's in it and understand what you own. Don't just buy it because it has a low MER, or, you know, do your homework. For a broad index link strategy, a bit less homework. We dove into the details and the valuations on some of the big holdings in the clean energy ETF this week. But I would encourage you to do that if you're going to use some specialty ETFs. People ask about the VIX strategies all the time. the average person should not be using these things. They can be toxic to your portfolio if you don't understand yield curve role and futures markets and so forth. How concerned should we be with ZWU on one of my largest holdings with all the noise and interest rates rise? ZWU, utilities, pipelines, telcos, is more interest rate sensitive. As rates rise, you'll see a little bit of price weakness there for sure. But I don't think rates are going to rise enough that it's going to be a material impact on earnings. The idea that utilities do poorly with rising rates is very true and correlated, but I don't think interest rates are going to rise enough to matter before the Fed will have to start cutting them again. So we are in a low interest rate world, and getting quality dividends off utilities with a covered call overlay to me remains an excellent, excellent strategy. I continue to be a big user and a big advocate for ZWU as ways of getting yield into your portfolio. Now, how big is that as part of your portfolio? I'm not saying go add to it. Okay, if it dips below 12, yeah, okay, add to it. But I'm saying I use it, I like it. In my dividend fund, it's around 7% of the exposure. If this is 40 or 50% of your portfolio and you're clipping a coupon, there's a risk of this thing dropping below 12 again for sure. If rates rise high enough. I don't know how high they're going to go, but within a trading range, yeah. Should you try to time that? No. If it's around this with a little bit of growth for the next number of years, and you're clipping a 6 or 7% coupon, if that meets your goal and your mandate for why you own it, then I would say, by all means, stick with it. I have time for one more question here. Is there any chance there could be a pointer on the graphs to show? It would make it much easier to follow the talk, and I often get lost in the graphs. Ted, I get that feedback a lot. I put on a screen, it's very busy, and I kind of understand that. I will look into the technology that we use here on GoToWebinar and see if I can draw or use pointers. I'm not sure, but Ted, I will make that my homework for the week and look into it so that our viewers and our users here can get maximum utility out of these weekly webinars. So, it looks like we are out of time for this week. Again, a reminder for those of you who appreciate what we're doing and you think we can help you, one of our companies, if you're a financial advisor out there and you want to look at how to improve what you do for your clients, please have a look at qwealth.com, and I think you'll be pleasantly surprised. For the individuals out there, if we can help you with your portfolios, let us know. If we can help you with your financial plans and your retirement future, by all means. And if you're looking for information for the women out there, and men read this too, by the way, Golden Girl Finance, please consider making a donation to thank us for our efforts here. And have a great week, everyone. Go Leafs, go. See you next Thursday.